Hey, it's Mike Lynch with AmeriFirst Financial, and it's time for your Monday morning mortgage update for the week of February the 28th. Last day in February. Man, it's gone fast. March 1st tomorrow. Hope you all had a great weekend. Beautiful weather, a little colder, which is nice, and we got a spit of rain. So it wasn't much, but hey, we'll take any rain we can get in the North State. So what happened last week and what's going to happen this week? How will it affect mortgage rates? Remember, this mortgage update that I've been sending you for the last couple of years is all about how the economy affects mortgage rates. So last week, gosh, Russia went to war with Ukraine. Our hearts go out to all the Ukrainian people. This is just tragic, and we hope that this resolves soon. MBS prices, mortgage-backed security, the market was very volatile last week because of this. We had a lot of economic reports that showed the economy was actually stronger. High core inflation, 5.2%, huge number. This is a scary number as far as inflation. I mean, when I go to a local grocery store and I spend $6 for a small bag of Brussels sprouts, crazy. We all know everything is costing more. But that core inflationary number did not move mortgage rates higher, which it should have, because of the war, because of what happened with Russia and Ukraine. And so when there's uncertainty and fear, there's something called flight to safety. I'll talk about that, which absolutely has an opposite effect to the mortgage-backed security pricing than we saw. So what are the three things? Russia and Ukraine, central banks, and then the economy. So flight to safety. If everybody feels fearful, and I want to talk about everybody, investors, foreign investors, your 401ks in the bond market, 403bs, people invest in the bond market. They put their money there because it's a safe place to put money. You get a lower rate of return, but it's a safe place to put money. So when there's this fear and uncertainty and instability in the European area, money flows to our safer, stable bond market. And that's what happened last week. This war is going to have a huge financial impact, not only on Europe, but globally. And you probably don't know this if you've been watching the news, but Ukraine really is the breadbasket of Europe. A lot of resources come out of Ukraine, and this is going to cause massive disruption to what is exported from Ukraine and European countries that really import a lot of the goods from Ukraine. A lot of countries that typically are neutral are now going against Russia. Even Switzerland, which is notoriously a neutral country, they're imposing sanctions on Russia, just like the United States and many, many other countries are. And this is going to have a massive, massive financial impact. The Russian ruble is down 35%. This is a huge reduction in the ruble. There's run on banks. Russian banks can't get their money, and rightfully so. There needs to be some impact here. But the impact to the global markets really hasn't been felt yet, but it's coming. Second thing is central banks. So our central bank, our Fed chair, is going to be talking this week about policy that we've been talking about really starting in March. Are they going to get out of the bond market? Are they going to rise or hike the Fed fund rate as much as a half point, which some people have indicated they should? Are they going to stop reinvesting in the bond market? All of this has an impact on mortgage rates to go up. And the bond market and the bond traders really have already priced this in to the bond market. And so will the Fed chair indicate that there's going to be a change in his position, the change in the Fed's position? Russia increased their Fed rate, the similar rate, from 9.5% to 20% last week. Huge increase because of what's happening with all the sanctions, how it's going to affect their economy. And other countries are starting to increase their Fed rate as well. So we know one thing: our Federal Reserve will stop buying mortgage-backed securities next month. That's absolutely going to happen. We don't know if they're going to stop reinvesting in that bond market. And we don't know if they're going to still hike the Fed fund rate next month to a half point. They may lower it to a quarter. They may decide not to hike it at all because of what's happening in Ukraine. So all of this is going to cost higher energy costs, supply chain interruptions globally, and that's going to affect the decision of our Fed. The economy. So everything that we're seeing is showing the economy is actually stronger. We've got a bunch of reports coming out this week, jobs reports, manufacturing, wage reports. It's all showing the economy is moving in a strong direction, but all those reports are offset by what's happening with Russia. So we should see rates much higher than they are. The fear and uncertainty is causing these rates not to go up. And so we just have to watch and see if really the war is going to impact rates in a positive way this week. Keep in mind that if it does, it's temporary. Eventually, there will be stability or an acceptance of what's happening with this war. It's not going away anytime soon, most likely. And the economic reports that are pushing to higher mortgage rates are going to take in effect, and we're going to see these rates go up. Will it be a week, 2 weeks, a month? We really don't know, but it is coming. So another volatile week. Everything points to higher mortgage rates, worse mortgage-backed security pricing, but the flight to safety from